We're here today to talk about corporate innovation and how they need to partner with startups and why it's so crucial in these unprecedented times. I want to introduce Kerry Allen. She's our first fireside chat speaker. Kerry is an astounding leader in the Boston ecosystem and an international leader in both education, the arts, and innovation. So Kerry, unless I've missed anything, why don't you tell us a little bit more about what we're going to be talking about today and introduce this accomplished gentleman we have sitting with us.
Okay, great. Thanks so much, Shawn. I am Carrie Allen, and in partnership with Venture Cafe Cambridge, delighted to be hosting these fireside chats on corporate innovation. I am the managing partner for CIC Captains of Innovation. And for those of you that may not know, Captains of Innovation is a boutique corporate consultancy where we help corporates at every spectrum of innovation, from looking for startups all the way to strategy and beyond, and roll up our sleeves and help develop things with them. And I am delighted to have Shaun Murphy as my guest. Shaun's a dear friend, and in the early days when I was creating and launching Captains, he and I partnered together quite a bit in working with our corporates. And so a little bit about Shaun. He is a Serbian-American entrepreneur. He has a great sense of humor. He's an innovation practitioner, a technologist with over 25 years of experience. And so he has founded 4 startups. He is an astrophysicist, and actually when he was working with Draper and NASA, created the technology that allowed the Mars rover to find water on Mars. So that's a pretty big deal. And even after that, for Royal Dutch Shell, he created their innovation lab, Shell TechWorks, and has a lot of experience with corporates and working with startups in that regard. And now he's working on his own startup. He's the founder, CEO, and CTO of Titan Advanced Energy Solutions, which is working in the battery space. And so welcome, Shaun.
Thank you so much.
We are so excited to have you here. And so the topic of our conversation is around the importance for corporates and startups to work together. And in normal times, we say this is something that really needs to happen because oftentimes historically, corporates would work sort of internally in their R&D labs and not engage with the ecosystem and look for other things, including startups and technology that might possibly disrupt them. And so everyone knows there are all kinds of great examples now of how that's happening. And so we always encourage our partners to constantly engage in the ecosystem and keep looking for startups. Now, you have great experience on both sides of the spectrum, working at Shell and running startups. And so first, would you like to say a little bit about your experience, your wealth of experience and what you've done in terms of both corporates and startups? And then we can sort of engage in conversation around how you think the best action is in order to help corporates and startups really work well together.
Yeah, thank you. First of all, thank you, Carrie. It's really awesome to see the CIC family again and to see Shaun. I haven't seen Shaun since the drinking days of Cambridge at the Venture Cafe, and thank you for inviting me for this. What I would like, and thank you for the very nice introduction. The question is, I always say, why do startups and strategic companies have such a rough time of dating? And dating, I think it's a kind of operative word regarding that, because it's how to match those two organizations or two type of things together is very difficult. And it was difficult when we were on the Shell side, because what we had scouting organizations, we had university organizations, we had venture groups, and all those systems around the globe. Not only that we were dealing with different startups with different cultures, different norms, different law systems. Everything was very complex, and how to get just that critical technology or critical team that you integrate into your company that you can scale up and be competitive. And that was very difficult from that side. On the other side, you're a small startup, you're focused on your product, you're pre-seed or seed or pre-A funding, and how do you find your strategic partner? And that is a very difficult thing. So I'm going to tell you the story of a little bit of both, and even in the middle.
Right.
And the reason why the middle part was with CIC. So what happened was when 2012, found that I was approached by the CTO of Shell to find their advanced engineering group called Shell TechWorks. Basically, what we did, and they still do, is develop high-end engineering products that would basically absorb startups, absorb technology from outside, incubate it inside of it, and then scale it later on for Shell to do things. And because the problem is, and this kind of goes to the root of the problem, is that the speed of a large organization or the transparency of a large organization is 0 to none, meaning it goes slow. It's very hard to see what is the strategic goal, because if you go on Shell's website and it's like, oh, we want to be the greenest company in the world or whatever, it's very hard to translate. I am a small little company with a super duper widget that's going to help you, filter the water better or process something much better. How do you translate that high level goal in a large company to something? And then, so that kind of goes to the most important thing and the first thing a startup needs to do, but at the same time, the first and most important thing a corporate needs to do, and that is create its champions. For the startup is to find the champion internally, and from the corporate is to empower the champions that they can go around and find the needed technology, the future technology, but not just kind of do a show and tell and marketing and check boxes for your bonuses or for anything else, but truly follow the mandate of what needs to be done in order to get that technology from beginning, meaning evaluation, integration, basically mass production, and then commercialization. And that whole process usually takes about 4 to 5 years. So a lot of people have to have patience, and that's a lot of time in a large organization because people move around. That's very difficult. So you have to have a structure around it that enables that patience and that flow between the two organizations. So that would, so if I would have like 5 things, that would be one of the most important things.
And related to that then, did you specifically go looking for a solution, or did sometimes startups just come to you and then it fit? So I know when you created Shell TechWorks, it's an amazing example of corporate innovation. You did things a little bit differently while you're working with the business units. And so would you have a particular solution in mind that you would go look for?
It was a little bit of both, and that is a very, very, and it's like you do a mixed strategy of how to go about it. First of all, most startups have no idea what the big company wants to do. What's their secrets, or what do they want? What do they want to drive through? What's their strategic goal? I mean, they're really, and if they do, then you're not keeping your bookkeeping correctly because it's all over the world. So it's like, if I always say, I really, if I'm an investor, I really want to know what Jeff Bezos is thinking, not his portfolio or prospectus. I don't care. Everybody knows that. But what is in his head? And that's the exact same thing. Is most people outside, they did not know what we really wanted. What type of technology do we develop? So what we did a mixture of seeking out companies. The way we did that, we partnered with companies called like 9 Sigma. We would use our own network through the CIC. We would go through the university. So we would place RFPs. And at the same time, we would try to develop some stuff internally as well. So it was basically, some would come to us as well because we would go through the MIT Energy Initiative. And this is basically our corporate relationship we had with MIT. And we told them, this is our general guidelines. Here's a bucket of money. Please, if there is people want to come and develop technologies, and that's what that would do. And so there was an influx of companies, but at the same time we were seeking out.
Sure. And
Sense
then
was a
what,
perfect example of that.
okay, yeah, I was going to say, can you give us an example? Once you found a startup or technology that really aligned, what next steps would you take? This would help some of the people understand. Yeah.
Sense was, if not too many people are familiar with, the Sense is a company that is located in Cambridge. And what they do is behind the meter machine learning analysis of how you use your electricity. So you basically hook up your leads in your basement where your basically your electricity comes in, and it would sample the flow of electricity about several million times per second. And from that algorithm will then determine, do you have a light bulb? Do you have this? Do you have that? And it does that automatically. And then from there, you can understand where your usage of electricity is. And that data will be sent back to Sense, which will sell it to basically the utilities. We thought it was a good technology, so we sought that company out. Fortunately for us, they were looking for a Series A, so we engaged with them, spent some time doing the due diligence on the business side, doing the due diligence on the technology side. And the most important part, and this is the second most important part after your champion, is to create a joint value proposition. Because their value proposition was for residential, for utilities, but we thought that technology could be created for industrial, for rigs, for processing. So we created a new value proposition together with them because they knew their technology, we knew our business. So we sat together and over a period of a couple of months created a value proposition which allowed our venture group to come in and lead the round for Series A. And that was the critical part of that we had to kind of have a vision, which was kind of fuzzy and you can't see it that much. But then once you get together, you really rapidly together sit down and create a joint value that both parties can happen. And we brought it together. That's an example for investment and we seeking out a company out.
That's fantastic. And let me just say to everyone who's here, if while Shaun is talking and sharing some of his experience with us, feel free to pop some questions into the chat because for the last 15 minutes, we want to open it up and answer some of your questions.
Perfect.
Okay. So, you know, I'll sort of jump back one more time and kind of say how we should talk a little bit and touch on how important it is for corporates to actually engage with startups. Because first of all, there's so many unknowns during this time, and often they could answer or solve a solution much quicker by partnering with a startup. And so that can look very different depending on whether or not they want to invest in a company or just even be a channel partner or do a JV partnership. And so your experience working with business units at Shell or with different people, engaging and scouting for startups. I know you used various models or went to universities to look for research, MIT and so forth. But I want to reiterate and hear your thoughts on, you know, for the corporate partners, you know, listening in right now, why it's so critical to look outside for possible solutions and partnership to move your innovation faster.
You know, sometimes when you're inside of it and you're outside of it, it's like the most obvious thing in the world. So first of all, there's more smarter people outside of your company than inside of your company. That's just a given. Because if you think about how many small companies, big companies outside of your ecosystem, you have a limited amount of resources, so you're a limited amount of people. But what you want to do is to leverage all that knowledge from outside. What startups bring is they have two superpowers, as I would always say, that these are superpowers. One of them is speed. So they move, they have an insight of a specific solution that all of us overlooked. And it's always the case. You can read through all the books and all the businesses and everything else. When the birth of a company is that they have a specific insight in time and in space and in market conditions that allows them to grow and disrupt the field.
Mm-hmm.
When you are, and this is always the problem, if you are in a larger organization, your main job is to maintain status quo. I mean, you have their bottom line, you have this, your 95% of your business should be just doing that, or 90%, unless you're, some R&D organizations like Philips, which has a big chunk of their portfolio, or GE, or used to be GE, the large portfolio is on the future. But most companies, for the most part, big part of it is market acquisition, improvement, incremental improvement, but that does not save you from those, not to say black swans, but those, blind spots that occur continuously. And sometimes a competitor will have that, but in most cases, it's a small company that develops something very specifically that they cannot do it themselves. But if you just take that and tweak it a little bit and add it to your superpower, which is basically market position and scaling and capital, that's usually a larger corporation has that, meaning has established itself, has a channel, sales channel, has a supply channel. It can really leverage that startup's little gizmo or team or whatever you want to call it, and what it is. And once they bring it in, it changes the game. And so all of a sudden you can change the whole dynamic of the market very quickly by leveraging the outside. Otherwise, it's very hard to do internally.
Well, given that, I'd like to actually shift your hats here, because now you're on the other end, and you maybe tell us a little bit about what Titan is doing. You've invented something amazing, created this battery company, and now you're working with large corporates as a startup. And so I think you are unique in that you can talk both sides of the coin, and we're getting some great questions about the balance between startups and corporate partners, and navigating the power imbalance. So Charlie Parker asked that. What are some guidelines to managing the power imbalance between startups and corporate partners? Which is really interesting, and it's something at Captains we work with our startups and corporates really carefully to manage. But I think given your experience, and then as you're working with Titan, with large corporates, I think something you can also talk about is the importance of testing fast. So can you share a little bit about those? I've just thrown quite a few things at you.
Yeah, you're right. So leaving Shell, went and started another company, and it's called Titan Advanced Energy Solutions. That's the logo behind us. And what we do, and I'll just give a 2-second background so that you understand why did we choose the specific corporates, because we wanted to get a strategic partner for an investor. And that was a critical component for us in order to do just those things, to scale the technology, to protect us in other markets that we cannot be protected because you just don't have the reach and the marketing and all the rest of stuff. So what we do is we developed the ultrasound technology. Basically, first it was off the shelf, but now we're miniaturizing this. The same thing like when you're scanning babies, when mothers are very pregnant and then you want to look at the baby, we do the same, but we do it for batteries. And what we do is with that same technology, we improve the reading of batteries. And when I say reading, we can determine the state of health and state of charge of a battery about 2 orders of magnitude better than the current electronics does in the marketplace. And I say, so whoop-de-doo. Well, what is that important? Well, because of that high accuracy and high precision, it provides you about 20% more capacity, and it gives you about twice the life of the battery system. So if you have a laptop that lasts 2 years, it'll last 4 years. If you have a car, like a Tesla car, the warranty will last 6-7 years, it should last 14 years. So it's a big economic thing. And if you look at for stationary storage, it's a big economics. But anyway, so what we needed to do is we were looking for a strategic partner when we were going through our investment portfolio. So we chose two at the time. And it took us a long time which one to choose. And one of them we chose was Schneider Electric, and the other one we chose was BP, British Petroleum. And for two different reasons why these strategic partners that we started engaging with them. On the BP side, we chose them because they bought ChargeMaster, and they were the largest recharging station in UK, and they were expanding in the US, and they were trying to rebrand themselves as an energy company and a company that is going to move into the electrification space. So this is, and without batteries, there's no electrification. That's just, it is a part of the ecosystem. You can have nuclear plants, you can have power plants, coal, you know, wind, solar, doesn't matter. But in order to deal with this arbitrage, meaning daytime, nighttime, where you have most of the people, you don't have plants, where do you have the least amount of people, you have solar, you have to have this kind of balancing issue, and that's done with lithium-ion batteries. And BP understands it, Shell, all these companies understood it. And the other and so we started engaging with them quite early, about a year into it, but they fell into the same classical trap, not to poo-poo over BP, but what happened was they were too much into their own politics inside the company. Mm-hmm. And there was a law, and I would recognize it because I recognize that same politics at Shell. And even though I spoke their language, they're a petroleum company, I knew exactly who to go to, how do we start, but all of a sudden you can see this tension of Silicon Valley venture group and their group in London, their group in Paris, and constantly maneuvering around. And it's almost, they're trying to fit it for depending on their, call it personal gains. So what you see is, unfortunately, an organization that has the right intent, the right amount of money, but the structure that they set up was wrong. So when we tested our champions, they could not follow through to our system. So then I'll take it to the second, and we were thinking about maybe both or invest. The second was Schneider, which we chose as well. And what we did with them, so Schneider Electric is a supplier of equipment for utility grade systems. And they are a French company. They've been established almost 100 years ago. So most of the stuff that National Grid uses is Schneider equipment behind, in their large presence in Europe, US, China. And so they have their big business in uninterrupted power supplies. This is your Amazon data services, Microsoft, Google, all of it's backed up on Schneider batteries. So we thought this would be a great fit, and they thought so too. But that took almost 6 months to figure out. Mm-hmm. And our first thought of a value proposition was to go into UPS space because it made perfect sense to us. And then we sat down, and then how UPS space is structured and everything else, it actually did not work. But one of the champions inside of it, Jean-Luc Meyer, who's on our board right now, he understood the value of the technology, and he truly grabbed us, and he went and championed us to various business units until we could try to create multiple business kind of scenarios, mm-hmm. until something really worked. And on the end, it was stationary storage that worked quite well. With new and with old batteries, we made the business case. We created basically a pilot program within. And then with the pilot program, they decided to invest. And we both, and the other thing which is really beneficial for a startup, if you're listening, strategics are much better at giving you a better valuation than, because their value is not the money that you're going to bring them. Their value is that critical technology that you can bring inside a company. While on the other hand, we had a a company called EIC, they're a standard financial organization. They pushed really hard for valuation, but on the end, we got a higher valuation because Schneider thought this is a better deal and they wanted this technology to be competitive because otherwise they're not competitive to their direct competitor, which is ABB.
Sure.
So,
well, I think that's a great example. And honestly, I think you said it was about 6 months. That's relatively a short amount of time, given, how long some corporates take. And that's, just because by nature, they're large, they can have a lot of red tape and bureaucracy that they need to get through. But in
6 months was when we started really working, when the first introduction was about, and we started, there was this call at Greentown Labs, there was Bold New Ideas, that was in September, and we closed around in July.
See, I think that's fantastic, and the fact that you were able to kind of move fast with the testing and find the right business unit to work in. And I think this is relevant to everyone listening, whether you're a startup or a large corporate. Some of the lessons is that Shawn, said, number one, you've got to find your champion within the large corporate. So it could be the innovation group, it could be a certain business unit, it could be one person that's working very closely with the CEO or the CEO directly. But in today's world, now that we have COVID-19, I think it's even more critical that corporates are able to change and pivot rapidly. So, I'm just going to, ask your thoughts on how can we, give advice to corporates and startups, how they can perhaps test more quickly or understand or look for technology that might be in an adjacent field that could solve one of their solutions. I think you're really brilliant at that. Pulling apart one thing to make something else with it. So do you have some thoughts around that?
Yeah, it's truly, and on our side, we feel the pain of the COVID effects because most of our customers are automakers, meaning the tier one automakers, because this technology is gonna, and I can tell you, it's slowed down to a trickle. And even though we're pushing and moving things along, I can't even imagine how to initiate new projects with new systems. It's not going to happen from the startups will always be there, but how do you understand which is the right one? As I always say, there's a signal to noise issue with that. Mm-hmm. So what I would recommend to the innovation groups, and this is now, I'm glad that from when Kerry and I started this many years ago, most people did not understand what innovation is. It was just a rebranded R&D. Right now, it's actually, there is a thing that is open innovation, and that is really happening. I would say that try to get out there, speak with a lot of people, create a multi-tier system of filtering. So you have a low pass filter, high pass filter. What I mean by that is create a forum such as this and you state what you want. Then you grab maybe 10, 20 interviews, do a half an hour interview, value proposition. I know that half an hour per 10, that's quite a bit. But then at the same time, you have to do your homework. The worst thing in the world to do is to go on the interview and not doing your homework. Because not doing your homework, not reading about the startup, or not doing what they do or who the founders are, it's going to be a waste of time of everyone. So that preparation up ahead is so important. It's rather to have less people on that call or less filtration, but have the homework behind you done. And then once you come to that, you can go and have another in-depth technical business session. And one of the tricks that we always did, well, I call it a trick, but I don't think it's a trick, is to do, and I'm like sometimes Captain Obvious, that's what at least I think for myself, is do a test pilot. I mean, you can do 25,000, 35,000, 50,000, do a proof of concept. For a startup, that is gold. 2 reasons. One, it pays them their bills, they buy critical equipment, they can get a subscription to MATLAB or whatever it is, and gives them validation that somebody's interested. I mean, having a logo of IBM on your website is an epic. even though it's very small, but it's very important. And then what that does, it creates the momentum. So you're basically this almost like the seed funder, and all of a sudden and then somebody else will come in. So you're leveraging somebody else's money to mature this technology that's coming along. And so you have this almost like this virtual incubator, but as they go and they validate the first POC, they got to move it to the next level. And then what happened is then you can do a partnership or whatever your strategy is. But that's a good way, and hopefully we will be opened up in
Yes.
months or maybe
Yes.
half a year, and we can do business as normal, but maybe in 2 years.
Well, those are great points. And, one of the things that we tell our corporate partners all the time is if you have $1 million to spend it on 10 different startups or ideas as opposed to just one, because innovation is hard and it's not a linear process at all. I think even during these times, you're able to scan for maybe solutions, and we're constantly still helping look for startups for our partners. And so the reason I say that is because Vera has some great questions around before you have a joint value proposition, how can a startup catch the interest of a big corporation? And then she also put another interesting question in terms of oh no, Ori also asked, what is the optimal stage for a company to engage? You mentioned Series A. Should a company try to engage sooner? And I see interest at every level, but corporates have a very specific need. So oftentimes they may say the startup has to be Series A, or sometimes they just want nascent ideas to get in early. And so I don't know if you have any thoughts about that, Shaun, as well.
It's depends on their portfolio, how it's set up. I mean,
Yeah.
ADI, which is a semiconductor company over here, their whole, what they call it, innovation garage, they used to be at the CIC for many, many, many years. And their whole thing was not, it was always seed. It was to grab ideas from MIT, from small companies, and fund the two or the one founders that have early on idea, and they will bring them as an employees into ADI. So they would absorb that idea really early on. Some companies generally like to do B rounds. That's because, the more conservative the company is, the later the stages it goes. It's funny. It's actually later stages and early stages.
Right.
And because it's the early is very cheap, but the late stager is, it might cost $20-30 million, but guess what? It's C round, so it's already established. It's, pre-IPO, whatever it is. You're buying it's like going and, you know how to play poker, so you're buying yourself on the table. But the tricky ones where the maximum value and the most disruption happens in that between from the post-seed round or the seed round, which somebody already did some validation. So you want to look at that, or that the founders really spent their own money and they did something really good. From that point until A round. That is because once A round you're already going to pay a lot to get into the table. That's already expensive. If it's a really good technology and a really good company, the value for a B round will be upwards of $100 million more. And to get into that, the B rounds are usually, you're gonna be an observer or a participant on it. You might eke out some deal on the technology. So if you really want to be competitive and you really want to get the whole, you got to risk. And that risk association is that project money or Series A. It's one of those two. Right. And so how much do you want to risk and how you want to do it? I would prefer, as a startup, I would prefer project money. Because what that does, it gives you non-dilutive capital and gives you validation and gives you a path to market. And the same thing is that for corporate, just do that. Because it will figure out how the cultures work, the value proposition system will work. the venture capital can come in later and really scale it up. But project money is so critical, and it could help far more than other things. Because let's say that you have, your strategic partner, and you have, a good project with them that's worth a couple $1 million down the line. The investors will shore up that company on the side because you have that portfolio, you know where you're going. So that's a way to go.
Yeah, no, I think I would advise startups and corporates to do that as well. And in fact, some of the corporates we're working with right now are looking for partnerships like that to do test pilots and projects, because it's a lower cost for them, but then they're great channel partners and the great, weight of everything that they know that they can help that startup work through, whether it's technology or testing with focus groups and customers. So that's great. Well, I would love to open it up for some questions now. We're about 4:38. We've got about 22 more minutes. Does someone want to throw a question in the chat for me to ask, or would you like to unmute yourself? And if you have a question for me or Shaun.
Yeah, I had a question. So it's going to be a little longer, but I'll try to keep it as quick as possible.
Okay, thanks, Vera. Okay.
So I read an article earlier this week, and I have not stopped thinking about it since, which was on, so a set of corporates that is doing this type of work very efficiently right now is in the pharma field. Right, in pharma, you're very used to big corporations just dumping a lot of money in startups. And the article is basically proposing, well, if this works so well, why can we not have it in materials? Why can we not have it in energy? What are they doing differently that materials corporates are not doing? Do you think there is a world where we have exchange between corporates and startups that in materials that is as efficient as it is in pharma?
You see that I have a bunch of friends in the pharma industry, and they went through this cycle. So there's two things that in pharma that is slightly different than in most other industries. They're filled with PhDs. And when I say filled, it's filled to the brim. So it's a very academic, very research-based kind of field. So that's number one. So the other part is in order to get basically a product on the market, it takes 10, 15 years. And it's really a long time, this whole process of getting a product. But it's not even that it takes that long. It's the mentality that the people in the organizations know that this will take that long to go through all the certifications. So, and what they need to do, it's like a statistical game. I need to invest in 200 types of new technologies. I'll have my R&D, which will be improving R&D, incrementally, and I'm doing my main core, which I'm doing. But then I have to do another 50, 60, 70. Out of that, one will pan out. And that one would be Viagra or whatever. And it makes billions of dollars. That's the thing about pharma that it's very different, is that once you have that key innovation in pharma, you get granted, and then you have almost like this monopoly for about 10 years where you recoup on one product, you will recoup all the 100 other ones that did not work, and then plus for all the investors, and then some. So it's the structure of pharma that is very, very different than because the barriers of entry are very high. So you have maybe 10, 20, 30 large pharmas around the world. So that they have that type of structure. In the energy business, that is very, very different. And it's not as organized, it's fractured, and it's very politicized, meaning if you think about utilities, a utility in Massachusetts and utility in New Hampshire are completely different. The state regulates the utilities completely differently. and how much you're getting for the power, can you sell it to the grid, can you not sell it to the grid, the incentives. So, and you can't scale as easily. And then once you get out of the United States, you have good subsidies in Europe, but horrible subsidies in some other places. Or you have to be super connected with the political families in South America in order to get anything done. Otherwise, it doesn't work. So all of a sudden, all these, for utility / solar, wind, it's very, very, very hard to have this long term. And one thing that I have learned, and it's interesting you say that I learned in Shell was the cost of capital. Meaning there's this this cost of capital today versus the cost of capital 20 years from now. And that equation is remarkable, because if I invest $10 million today, I can just put it into whatever utility bond at 6-7% compound interest, and it'll give me X amount of money in 10 years from now. So I have to beat that by 10. And so that is that equation that all of us go, or the pharma goes, does this one product can beat that equation day in and day out? And so far they're succeeding if you get an aspirin or whatever. And but so does that kind of answer your question? I know the gist of your question. I could probably spend a day on it, and analysis of how can we learn from pharma. I wish other industries did that, but then we would pay iPhone probably $20,000.
Well, I'll add another bit of flavor here as well. You know, I think there's a larger barrier for pharma startups to get started, actually. And so a sister organization that grew out of CIC is Lab Central, and they've done a brilliant job because it's co-working with wet lab space. So they were able to give the tools and the materials to allow these startups to work more efficiently. And so that model is really helping, because a lot of people were saying the pharma industry is broken. As Shawn said, it's a very long tail, lots and lots of money for a long amount of time before the return. And I'm actually seeing a lot of different companies in terms of materials, whether it's, fluorochemicals or materials related to, big industry, that there is room. A lot of people are looking for innovation right now. And I think as a society, we're going to come out on the other side of this pandemic different. So you're going to have to also add in new elements around what is new social behavior? How do we act and behave? So what sort of innovations you need to create around that? But I want to point out, Shawn Hakimi has put a survey into the chat room, if everyone can please answer that. And then I'd like to invite, thank you, Vera, for your question. I'd like to invite Basuki, I'm sorry if I'm saying your name incorrectly, to unmute yourself and ask your question.
Yes. Hi, Kerry and Shawn. Thank you very much. Just real quick, in a downturn like today, as a small players like myself or a bunch of other startups that I know of, we always crave to build relationship with a larger corporation or companies, and with hopefully or making ways to kind of build either join innovations or even providing services to larger companies. But then in time like this, how should we position ourselves in your opinion?
So what I heard is, like, as a startup, how do you position yourself as in brand wise, as in value proposition wise to corporate?
Right. And given that nowadays a lot of corporations are looking to cutting costs rather than trying to spend on innovations.
It's a very, I think the cutting of the cost and external is actually far more valuable. You're far more valuable sitting outside than you're sitting inside. Because if you are a large company, you are paying, I don't know, $150,000 to $200,000 for a good employee. And so if you think about, if they are going to cut costs, and they sure do in times like this, let's say that they cut off 10 people, that's $2 million. They can fund a pilot project for you with you for $100,000 and get all of you guys working 10 times harder than 2 employees. So I would encourage actually that the companies, you know, and look at it, is that just think about these startup as contractors or remote partnerships. And I think about, and even in a startup which I'm leading, we, instead of hiring full-time employees for firmware engineering or for other aspects, we just hired contractors. And so what happened is there's a slightly higher level of management because you have to manage them because they're not self-managed. You have to tell them, okay, this is going to be the task. So there's a little bit of an overhead on that, mental overhead, but it's far easier to do it, especially with Corona, to manage external contractors that way than and de-risking yourself internally. But that small amount of money disproportionately is far more valuable inside of a startup. So $100,000 for a larger corporate, doesn't matter how big it is not even a rounding number. It's just something in the ether that gets lost, probably on, you know, the phone bill. But $100,000 for a project with a company that is extremely focused, your statement of work, which you write up, has to be very precise. You manage it. You can get fast speed and fast results very quickly. And you just have to find the right people internally that will understand that there is a long-term path and there is, you know, basically these de-risking strategies in between. And I think it's an opportunity for the right people inside of companies to think about that. And I always, when I bitch and moan about it all the time, because one of our car companies, you know, they're taking their time, and I was like, you know, this whole project is 3 lazy employees that you have. And they laugh, and I was like, but I can't fire them. I was like, no, you can't, but somebody can. And then all of a sudden you can get 20% more market share. And they say, you're so cold. And it's like, no, because in 7 months, you're going to say, oh my God, this Corona thing destroyed us. We have to lay off now, not those 3 lazy ones, but 7 of them in order to overcompensate for all the losses that you made. So, because time is opportunity. And opportunities, the doors come and go. So don't think, a large company should never think about that you have an endless supply of money or endless supply of opportunities. You have to be careful about it.
That's
Great.
really encouraging.
Thank you. And I think we'll take maybe a few more questions. So Kevin has a question. Kevin, would you like to ask your question? Kevin Marty.
Yes, sure. Thank you very much, Shaun. Very inspiring. My question is here, have you seen in certain areas, you know, the talents are very rare. So have you seen the corporations invest in certain startups because they intend to acquire the talents rather than invest in the idea?
That's a West Coast mentality.
Mm-hmm.
East Coast is less, but West Coast is far more often than here. I've seen it happen. As I give an example, ADI does that at early stages. They will gobble up the entrepreneurs with their technology early on as they come out of school. But generally, they do not acquire talent because it's a very rare thing on the East Coast mentality. West Coast, I've seen it done where companies would just buy the people, or they would buy the product, but the thing is, you're getting very low value because I forgot which book it is, but there is a nice little equation which gives you, if you're getting acquired, what is the value of your company? If you have if you have the IP, it's in the idea, you lock that up and you get all the PCTs, and if it's really valuable, you might get $1 million or $2 million. If you got the IP and the people behind it, and you have no product, and you have a prototype, you might get 10 million. If you have the people, the IP, and some customers or the product, you're getting 10, 20 million. If you have the people, the product, the IP, and the market, early stages market, then you go 30, 40. You can get that. And then on the later on, if you have a product that's in business and is generating money, then it goes into the hundreds of millions of dollars, depending, of course, on the market. But that's that. So when you look at it as the problem is this equation is, you as an entrepreneur, you know, well, if I hold off another year, my value doubles every year, or quadruples, or goes on this exponential. And you is how you call it, the corporate, you can say, well, I'm going to buy him, but am I buying him as an employee? He's just going to get a salary. And so it's very hard to do that, that dance between the two.
Right. And I'll add that is when corporates are investing in a startup or an idea. Oftentimes, if you're going the route of venture capital, they invest in the leadership of a startup, whether or not it's based on the idea or not. So there is that dichotomy there.
Yeah.
But
oh, yeah.
Thank you. Yeah, thank you both for that. And so now Fred had a question. Fred, would you like to ask a question?
Yeah, sure. Thank you, Shaun. Really inspiring. Around project money, you know, you're mentioning like if it's 100K, it's going to be a drop in the bucket for the corporates. But for some I'm in the clean tech industry, and some of these pilot projects are more expensive than 100K. They can be 500, 1 million. If you're designing a new gas fermentation reactor, maybe it's going to be 5 to 10 million. So how do you convince a corporate to give you that money? What can you get in return? If you're on the corporate side, you know, it's fine. At the end of the day, it's a financing thing. So what's the return on investment for the dollar that the corporate puts? So what are the leverage basically you can use beyond equity to convince a corporate to invest in your project?
So what I would say is scale down your project to its bare essence to show the value proposition. Because are you selling a competitive technology, or are you selling a system? And if you're selling a system, it's going to cost multiple millions of dollars. That's usually what it is. But if you are selling the principles behind it, that they can think about investing through joint development agreements or NREs or whatever it is, you have to lead them. You can't go and say, okay, I'm going to give you this system and you could swallow it or not. And usually that doesn't work. So what you have to do is very gently say, okay, here is your existing system. If we add a component or add the competitive advantage, what we think that we are best at, our core value or core system, maybe that is a scaled down version that they can buy at. Because once they incorporate that and demonstrate it, then the thing is, large companies will not invest in big investments outside unless it's a off-the-shelf technology from a known supplier that they know the ROI very clearly, that has been vetted. That's the supply chain. So in order to get through their R&D, you have to go through their gates, meaning you start with the core aspect of it, something that is core to you, but it's a direct value demonstration where you want to be in 2 or 3 years. And a couple $100,000 they will sometimes do. And once you do that, then in a successful project, all of a sudden, then that champion of yours can go to the next level of your group inside of it and ask for a larger pilot or scale it up. And then once you do that one, and then you're going to go start talking to their supply chain managers. And that's ultimately what you want to do, is to become on their vendor list. But that's a long process. I'm going through it right now. and it's a pain in the butt. And it takes 2 to 3 years. We expect it'll take us 4 years to go through that process, and that's exactly what we're doing. And if we told them, well, take this product, and it's going to and the product to miniaturize it and make it like that, it costs almost $3 million, and they would just say no. So what we do, we start from $100,000 project that kind of they can swallow. They can see the value. The manager can see the value. It can integrate into a strategic roadmap, and then you go to the next one. Then you create a pilot that they can. That's about $1 million, and it's slowly managing relationships. And ultimately, you're going to go into their vendor list or their OEM supply chain, and you integrate into that. And once you integrate into that, it's very hard to dislodge you. So I know exactly what you're asking, because I am, for the last year or so, we're doing exactly that. And it's just a painful, slow process, and I wish it could go faster, but that's why Zen Buddhism exists, so you can meditate.
Do you get corporates asking you for like exclusivities or sharing IP or?
Oh my God, yes.
More or less, unreasonable or more or less reasonable claims, like because they want something out of it, and then they're not going to give you 200K for free just so that you can test your technology in their systems.
Oh my God, yeah, I can. There are nightmare contracts. Nightmare. I mean, it's like this. Do we have money now? Do we don't have money? Do we give them something? Do we not give them something? Do we give them? And I would tell you, half of them want all of your IP for a dance. And then at one point, I just went and said, you know what? You guys have a very nice day, because it's like what you're proposing is just insulting. It's like, yes, I know you're a multi-billion-dollar company, but you know what? We're not idiots, and we're not like we're selling, snow to the Eskimos. That's not what's going on. And then you have to just walk away.
Well, Shaun, I know firsthand you've done a good job at being able to carve out certain bits of our IP for one targeted specific thing for a certain corporate. Yeah. So you may think about that as well, as what can you carve out that works for them, that doesn't, give it all away, so that you've got other space to play in as well.
It's very important to have a friend that is an IP lawyer. I have to tell you that. Because if you don't have a friend that's an IP lawyer, it will cost you a lot to get that same strategy. So try to find a friend who is an IP lawyer, or somewhere through some groups, because that IP strategy because they just want it. I mean, large companies that just want it. Because the mentality of it is they will, and it's unfortunate, that they treat the startups and this innovation groups, they would treat it just like vendors do. And but vendors are a different story, because there's no IP exchange. They're just going to provide you a finished product. They're going to give you an electrical motor. They're going to give you a widget. They're going to give you, and all IP and everything has been out there. And
I think I'm sorry, Shaun, we're now at 5 o'clock, and I have a few things to just close out with, but those are really great points. And I will just add though, but we're very grateful that the corporates are looking for startups too, right? So yes, they have their business interests at hand, and they're great ways to balance and to make the partnership work. And so first, huge thanks, Shaun, for joining us. I'm delighted to have you here. I think it was very, very intriguing and interesting for everyone. I'd like to thank Shaun and the Venture Cafe. My next corporate fireside chat will be on May 14th, so keep an eye out for that. And then I'd like to say, starting right now at 5 p.m., we have another session called Safely Operating Lab and Office Buildings Post-COVID-19 with Tim Rowe, CIC's founder, Katie Ray from The Engine, and Johannes Freundhoff from Lab Central. So thank you all so much. And Shaun Hakimi, do you have anything else to say? And Shaun Murphy, would you like to say anything?
Just say thank you so much for inviting me. It's been great questions.
Yes, thank you.
Obviously, it's a hot topic, and we could probably talk forever about that.
So thank you all for your time. Thank you for a lovely chat from our participants. You guys nailed it.
Cool. Thank you so much. Enjoy.
Thank you.
Bye, everyone.
Bye-bye.
Thank you.